Hello, my name's Stuart Lyons and welcome to my presentation, Three Statement Financial Models, How to Build Them. I'm a qualified accountant and I've been working for about 15 years, and I've made more three-statement financial models than my 3-year-old sons had cooked dinners, so you're in good hands. So the aim of this session, we want to understand what a three-statement financial model is, understand how those three statements interact. You're going to start building your own three-statement model with my template, and then I'm also going to tell you how to flex your model and cover some common mistakes in this section. So what is a three-statement financial model? Well, there's three financial statements. They're critical. There's the profit and loss, also called the income statement by the Americans, the balance sheet, also called the statement of financial position by the Americans, and the cash flow, also called the cash flow by the Americans. And how can you think of these? Well, if you don't know much about accounting or you don't know much about businesses, when people are thinking about a business and financial records, they're always thinking about the profit and loss statement. And this is where you record your sales and you record the things that you purchase at the same time. And it's people intuitively understand what a profit and loss statement is. The balance sheet, what's that? Well, this is where you record your assets, which are the things you own, and your cash, like your cash and your debtors, and also you record all of the liabilities that you have, all the people that you owe money to. And the important thing here is that 1 and 2 interact in that often or always a transaction that happens in 1 also happens on 2. You just can't quite see it the same way. An example would be if you sell a good on credit, then in 1, the profit and loss statement, you record a sale, but at the same time on the balance sheet, you record someone owing you that money. And the third financial statement is the cash flow. And this is where activity in 1 and 2 are turned into cash. So here's a hint. I've written a hint for us here. All three statements need to be joined together. You can't look at each statement in isolation. It is not a model unless it self-regulates. And this is a really important piece about three-statement financial models, is that they are all interactive. They interact with each other. A change in 1 impacts a change on the other, apart from really the cash flow, which is you take it or leave it from what happens in 1 and 2. But it's very important. You can't look at them in isolation. When you look at them in isolation, you get weird, wild results which don't make sense after a couple of months. So how do the statements interact? Well, I covered this a little bit, but I've written here, if something happens on 1, the income statement, something must also be happening on 2, the balance sheet. E.g., a sale will increase your trade debtors. So a sale on the income statement increases your trade debtors balance on the balance sheet, or a purchase on your income statement. So you've gone out and bought something, will also increase your trade creditors because you'll owe someone more money. Another point here, which I've written, is that everything doesn't immediately impact cash. Yeah, people always think, oh, I bought something, then that means cash out the business. No, it doesn't. That means that you are nearly always creating a liability to pay cash out your business at a later date. So the activity on your income statement is a transaction. This is how I like to think of it. The same activity on your balance sheet is a movement in working capital. They're two different sides of the same transaction, right? I'm going to say that again. The activity on your income statement, think of it as a transaction. The same activity on your balance sheet is a movement in working capital. And they're different sides of the same thing happening. Adding all these movements in working capital happens in your cash flow statement. So you add up all of those movements in your working capital, that happens in your cash flow statement, and every single movement in working capital should be in your cash flow statement, right? And that's what happens in 3. So you probably didn't follow all of that, didn't follow a lot, but if you can keep that in your mind, in the back of your head, 1, the income statement, something must be happening on 2. Yeah, if something happens on 1, something must be happening on 2. We call what happens on 2, balance sheet, a working capital movement. Right. So let's now jump into the Excel, and you can download the template in my link, and then you'll be off to a good start. Hi guys, thanks for joining us to have a look at this Excel file. So when you open up this Excel file called the three-statement financial model, and it should be available in the link in the comments or the link in this video, it'll open up and you'll see assumptions here, profit and loss, zooming in for the guys, number 1, financial statement. 2, group balance sheet, as the Americans call it, the statement of financial position, and number 3, the cash flow. And they're your 3 statements, your 3 financial statements. That's your 3-statement model. You can see here, I've also set it into years, FY22, FY23, FY24, FY25. When you make financial models, you'll make them by month, and then you'll immediately be asked by anybody when you present it to you, go, can I see that as an annual view? So here it is. And all that does is it's adding up 12 months going across when I open it up. I'll open it up now to show you. So FY25, you can see here, it's adding up the 12 months, which make up FY25. So closing that down, we've got the 3 statements, profit and loss, group balance sheet, and cash flow. And you can see underneath it, we've got a load of other stuff. Well, what the hell is this? These are your working schedules. We'll come onto them later. Don't be too daunted by them. They all work pretty much the same, but they are what drive your cash flow. Opening up the assumptions now. Now, the way I always set up my files is that I have those 3 statements all on the same page, and above my 3 statements, I have the assumptions. The assumptions are the cells where you can type stuff into, and they directly impact your model. And so you can see here, revenue is linked to revenue up there. Cost of sales is linked to cost of sales is linked up to these items, and so on. And that's so that you can impact your assumptions and it feeds directly into your model. That's just the way I like to set them up. Through doing these multiple times, I've realized that this, for me, is the best way of doing it. A couple of other points to notice on this spreadsheet is these items, cash, term loan. What the hell are these? Well, whenever you do a financial model, you plug in your revenue, you plug in your working capital movements, and nearly always, the first time you start doing these, your cash balance goes insane. It goes crazy, and you'll end up having a cash balance of minus 20 million or a cash balance of up 20 million. And obviously it's wrong, and it's wrong because your assumptions are wrong. We'll come into those common assumption mistakes later. But what I always do is I just have a cash balance underneath my assumptions here, which links directly to the cash on the balance sheet, just here. And that's so that when I put in any changes in my assumptions in this section, it feeds directly through to a cash balance, which I can see quickly, which can quickly tell me if something's going madly wrong and crazy. But you can delete these lines. Row 69, 70, 71. If you don't like them, you can delete them. You can also delete all of this junk, which is just from working files. This was a live working file at some point, so you can see why it's got some junk in there. A couple more things that are really important to notice on this working file. There are 2 key checks. There are always 2 key checks on every single 3-statement financial model, which are extremely critical. And you go down here. The first one is at the bottom of your balance sheet, or statement of financial position, as the Americans like to call it. And this is to check that you can see here 5111604. Ooh, didn't quite balance, but as a rounding error, that's unfortunate that we picked that one. But you can see here, the check here is to check that these 2 balance, right? And this is to make sure that your balance sheet is working. If this is not equaling 0 across, something has gone terribly wrong. You need to fix it. You cannot send anything out where that line is not zeroing out. The other key check on here is at the bottom of your cash flow, at the bottom of your 3rd financial statement, which is going along here, which is your cash flow statement here. Yeah, and what this does is this is your closing cash, row 194, your closing cash at the end of the month. In May 24 is 4.8 million, scrolling up back up to your balance sheet is 4.8 million. So what this check is doing is saying, is the cash balance on my cash flow statement the same as it is on my balance sheet? Obviously, the answer is yes, it has to be. The 3 statements interact with each other. That always has to be the same cash balance. If it isn't, something again has gone terribly wrong. Do not send out your work until you close that off. Those checks are critical. If it doesn't work, it doesn't work. Right, so I've been a little bit naughty here. I've opened up another file called trees, which is basically a very small financial model. And the reason I've done that is that to look into revenue, to see how a financial model works, I thought it would be easier to do it on a kind of more basic Excel spreadsheet. But it's exactly the same setup again, P&L, balance sheet, income statement, or as our Americans call it, statement of financial position, and cash flow at the bottom here. But as you can see, it's a little bit more smaller. There's all of these extra schedules, and I did this because it's just easier to explain on screen. It's less wieldy. So what you have here is in this income statement, we've got a business selling 4 separate products in rows 67 to 70. You can see here trees, shrubs, guards, moles, guards, coming up to our total revenue. You can see here the cost of goods sold. It's a negative and nice and red is this. And this formula, what this is actually saying is it's saying, you can see here in my assumptions, I've got a GP percentage saying that I am going to make 36.41% on every single tree shelter that I sell, and that's your margin. And I like to do my models like this. I like to say to do it on, I want to make 20% margin on this product, I want to make 10% margin on X product, and so on. And this is what that formula is doing. It's saying for of the 491k sales, my cost of sales is going to be 1 minus 36.41% to give me that. And you've got that with all the different products. You've got all those GP percentages up in your assumptions, giving me a total goods of sale, give me my total GP, that's my GP, and then you've got distribution costs, which we're going to say of all of our sales, it's 1% of our costs or whatever. Doesn't really matter what this is. It's just plugging numbers again. But that gives you your income statement down to GP, right? And that's important that you get that. And when you're building this, you should know this, right? You should know how much you are expecting to sell in each month, what you're expecting to sell it for, the cost associated with it, and what you're expecting to make. And that gives you your income statement, and that's most of your income statement right there, right? We're going to ignore all of this other income, these director costs, your overheads, because they're not that relevant at the moment. We're going to minimize them. We don't need to look at them because you've got the most of it. If you can do this, if you can work out this data for every single month, you're well on your way to making a financial model. But right now then, we have to jump into the balance sheet. And it's the balance sheet and the cash flow, which everybody finds, if I'm honest, a pain in the arse. So what happens when you sell something? Well, when you sell something, you're not always paid in cash. You might be, but many businesses aren't. You're paid often on 30-day terms. And so what that means is when I sell, what happens? So you look here, if you look in the trade debtors formula, what we do is we're using something here called your debtor days, right? And your debtor days is basically saying how quickly will my sale be turned into cash. And you can imagine that's because you're running a business and people say they're going to pay you in 30 days, but in reality they might push you to 60 days, etc. They might pay you in 45 days, they might pay you in 25 days. Nobody ever pays exactly on time. I'm sure we've done that all with our own bills. You try and stretch it out if you're short of cash, or you pay it sooner if you've got the money. And so the debtor days formula is turning your sales into your trade debtors. It's trying to say, if I sell 100 widgets this month, how much of that is going to be converted into debt and how much is going to be converted into cash. And the way that we do that is we use this formula called debtor days. And what this does is, you can see here, it takes your sales, so it's taking the total sales in October of 529k, and it's multiplying it by 30. So what I'm saying is that if I sell something in October, I'm expecting it to be collected within 30 days, and then I'm dividing it by the days in the month, right? And that's how the formula works, and that comes back and it gives me my trade debtors. And you do that for every single month, yeah? 30, the number of your debtor days, how quickly you think you're going to collect it, times divided by the days in the month. So sales times by your debtor days divided by the days in the month, and that gives you your trade debtors, yeah? And well done doing this, right? Once you've done this, you are well on the way to making your financial model, right? Really, really well on the way to making the financial model. So I thought we'd jump out the Excel briefly, just to kind of discuss what happened there, because it's really important that everybody understands what actually was going on and how is that interacting with those 3 financial statements. Well, if you recall, we had an income statement, a balance sheet, and a cash flow. And what we did was we created sales in October on the income statement of about 500,000, and then we applied our debtor days formula to turn that 500,000 of sales into a balance sheet item on our second financial statement in trade debtors. And then what we did was we did exactly the same in November, where sales increased to 1 million, and we applied the same debtor days formula to calculate trade debtors at the end of the month of November. And then that allowed us to take the difference between the October trade debtors and the November trade debtors, which gave us a movement in working capital, which allowed us to put that movement in working capital on our third financial statement. So you can see here what we had a sale on the first financial statement flowing through to balances calculated via our debtor days formula onto our second financial statement, which is the balance sheet statement. Then we did that for 2 months to give us the movement in working capital, the month-on-month movement in working capital on our trade debtors, which allowed us to put that movement onto our third financial statement, which was the cash flow. And you can see there we have created links and interactions between all 3 financial statements. And we did that just for sales, but what we now need to do it is for purchases and any other items that we see on our income statement or balance sheet. And once you do that, you build up your financial model, and you can see how you've got a financial model where it all links together and it all self-regulates. And we'll dive back into the Excel to look at that now. So just jumping back into this then, we use the debtor days formula to calculate the debtors driven or created by that 500,000 sales in October. And we'll do the same formula again in November. And you can see here there's been a 500,000 increase in sales from October to November, and that has had a corresponding increase in your trade debtors. And you can see here then that there is a clear interaction between your first financial statement, the income statement, going through to 2, your balance sheet, which is your second financial statement. And then the next piece is, well done, you've created your balance sheet item. How does that interact with your cash flow, which is your third financial statement? So scrolling down, if we look at the cash flow, you can see here PAT, profit after tax, depreciation, EBITDA. We're going to ignore all of those items for the time being. The key line, which is the link between your balance sheet and your cash flow, is the movement in working capital. And the movement in working capital is basically all of the balance sheet added up for 1 month, and then compared against the balance sheet in the following month, and the movements between those 2 line items. So your movement between your stock or your movement between your trade debtors, that's your movement in working capital, and that flows, the summation of all of those movements in working capital flow through to this line. And to show you what I mean by that is we're going to focus again on those trade debtors that you created, the 512, 500,000 trade debtors in October and the 1 million trade debtors in November, which has been driven by that increased trading volume up there at the top. And you can see here, if we scroll down, you've got in the cash flow line, movement in working capital, but that links through down to another schedule, which is your net working capital schedule. This is the most important balance sheet schedule. All the rest of it is pretty much junk. This one is really critical. And what this does is it just takes all of those balance sheet items, stock, trade debtors, VAT payable. The only one it doesn't take is cash, and we'll come on to that later. It takes all of those and you plug them in. They're a direct link back up to the balance sheet. And every single working capital item other than cash, which is on your balance sheet, has to come back down into your net working capital. If it doesn't, something's going wrong. So I'm just going to delete some lines here just for in isolation. It's going to throw out all of my checks, but we don't need to worry about that just yet. I'm doing that just to make it really, really clear, right? So your trade debtors was 500,000 at the end of October. It's 1 million at November. I'm on the balance sheet. You can see here though, it's I'm now on my working capital schedule, and you can see here exactly the same numbers from the balance sheet to the working capital schedule, and then I'm taking the difference between the two. I'm saying that I had in October I had 560 minusing by, so it's prior month minus current month, there you go, to get a loss, a negative outflow of cash of 500,000 quid. Now this always confuses people, right? It always confuses people. They think, oh, hang on a minute, my trade debtors had increased, but I've lost cash. How does that make sense, right? And conceptually, it's tough, right? I'm not going to lie, it does seem strange, but what you've got to think about it is when you sell something, you don't collect the cash immediately, right? And so if you're selling stuff and your trade debtors has increased, right? It has increased and it's increased over and above what it was last month, by definition, there has to have been an outflow of cash, right? And you can think of that as well, you can think about it. By definition, your cash must have decreased, right? And you can see here from the 512 to the 1 million is getting a negative cash outflow, a negative movement in working capital of 539k. And you can see that that feeds through then onto your cash flow statement, right? Here. And the reason why everything's been thrown out, all these checks have been thrown out, is because I deleted a load of other stuff. But I wanted to do that to illustrate there. So let's start from the top, right? Income statement. You sold that 529. You sold 529k in October. You use the debtor days formula to calculate your debtor days on the balance sheet at the end of October. In November, you sold 1 million. And again, you use the same debtor days formula to calculate your trade debtors balance at the end of November. You then plug those into your working capital schedule exactly at the end of October and the end of November, those trade debtors, to give you your movement in your working capital, which you put through in your cash flow, right? And you can then now see 1, 2, income statement, flows through to balance sheet statement, goes through to your working capital statement, which goes through to your cash flow. You've now created the very first link between all of those three financial statements, right? And that is how the three financial statement model interacts, right? You can see here something's happened on my P&L, something correspondingly has happened on my balance sheet, which has then gone through to my working capital, which I plugged through to my cash flow, which has spat out a cash balance here, which ties back 90k there, ties back to 90k on my balance sheet, right? And that is how they all interact. I'm just going to put back everything that I deleted there, just so it's not throwing everything out. And so you've done that with one item, right? You've done that with your trade debtors now. And all you have to do then is for each of your P&L items and each of your balance sheet items to do exactly the same thing. And that's how you build up your three statement model. And we'll do that right now. Right, so I just jumped back into our other file, the three statement model file, which is kind of the more complex model. And what I did in the trees file, which we just talked about, is I said, well, basically you've built your financial model, and I kind of smoked and mirrored way there, gaslit everybody by saying it was done, because I let out one key point on that, is that when we look at our cash flow, when we look at our movement in working capital, and we all now know that the key line in the cash flow is the changes in working capital, which is the summation, it's the summary line of all of the movements of what happened on your balance sheet. And so if you look at this model, let's scroll down to it, loads of activity, loads of different working capital items, but they all tie back to the items on the balance sheet. You can see here we had a movement, right? Well, you can't have a movement if you don't have a starting point, right? Because for the very first month, everything will be zero. So if you have an existing business and you're creating a financial model, you need to put your actuals in, you drop in your actual trade receivables, you build an actual balance sheet. You know, your accountant will have this done for you, or if you're an accountant already, you'll know what I mean. And that is your jumping off point from which you then add the first bit of your forecast, which calculates your trade debtors, which calculates your balance sheet of trade debtors, trade creditors, right? And that is your jumping off point. So you always need a jumping off point. If you're starting a business from scratch, the balance sheet is zero. That's very rare though. You'll nearly always be modeling from actuals, right? And so that is one of the key things, is you have your actuals, then you build your forecast on top of it. So in this case, right, these are actuals in August 22. That's obviously historical data. Actuals, because I built this a little bit of time ago, even though it's not December anymore, this was a forecast. You can see here, so you can see I moved from actuals in November to forecast in December, right? And that's where the model joins, and that's often where you get a crazy movement in working capital. So let's go down to our movement of working capital. You can see here, this looks pretty good because I've done it a few times before, but often when you join actuals to your model, you get a mad movement in working capital. That's because your debtor days are wrong. You haven't calculated your debtor days or your creditor days correctly, right? So the key thing here in your assumptions when you join your model is make sure your debtor days, creditor days, stock days are accurate. They're reflective of your historical data, and if they are, then when you join your actuals to modules, you won't get any mad movements in working capital. Now, I'm just going back down here, right? And I want to show you how I've done this in this model, the trade debtors revenue, right? And so when I built this model, this model was a consolidation for a group. It had a number of companies, but you could also think of those different companies as product lines. And I joined all of those companies up by having separate lines for revenue. And the reason that this is important is that you can imagine you have one product line where you're paid very quickly, or it might be selling widgets out the door, you're paid next day, or you might have another product line which you get paid 90 days later. And if that's the case, what you really need to do is you need to split your revenue streams and calculate separate debtor days for each of those different debtor days. So if you look here, debtor days 1, yep, and we calculate different debtor days for each of those. I've got different debtor days flowing through here, 85, 12, and 2, and that is giving a different working capital profile for each of my product lines. And the reason that that is important is because you might be doing loads of business, like in this case, revenue 1. Yeah, let's have a look at that. Revenue 1 has got debtor days of 85 days, right? And that's the biggest amount of our revenue. So if I was to say that if I was to take the average, which would be lower, you can look here 12 and 30, 12 and 2, right? This would be artificially distorting the debtor days related to our biggest chunk of revenue, right? I'd be saying that we'd be collecting faster this type of debt than we would actually, because it was distorted by the fast payment on these other two revenue lines, right? So if you have a revenue profile which is very varied and you get paid at different times, you want to break it up and you want to create different trade debtors for each of those revenue lines to model your working capital more accurately. And that's extremely important that you do that, because that will be how you get an accurate working capital profile off your debtor days. Right, so that was briefly ran you through how to make a three-statement model. And I know there wasn't a huge amount of detail because it is complex and you'd have to run through it. But the best thing you've got to do is download the files I provided, read them or have a go at them in the video, and then contact me if you need any help. I've made so many of them, it won't take me very long to help you. So to summarize though, what do? Well, first of all, you create your forecast P&L. Right, so you get your projections, you've got to know what they are, what you think you're going to sell, how much it's going to cost you to sell them, and that creates your P&L. And then from your P&L, you use your creditor days and your debtor day formulas to create a balance sheet, right? And once you do that, you've got your forecast P&L, and you created your balance sheet off it, and that with your debtor days and your creditor days. And the only item that's missing is your cash, and you don't have that yet, because then you need to get your forecast that you've made, your forecast P&L, your forecast balance sheet, which is missing cash, and join that to your actuals. And that actuals piece gives you the jump off point for your movement in working capital. Then once you do that, you take all of your closing balances, the very first closing balances, which is going to be your actuals, your closing actuals for the month, and you put them exactly the same items from your balance sheet onto your net working capital schedule. So trade debtors, trade creditors, stock, all of that. You plug in your actuals, then you plug in your forecast balance sheet items, your forecast trade debtors, your forecast trade creditors, which you've got by modeling with your creditor days and your debtor days off your income statement. And so then you have closing balances at the end of each month, and you take the difference between them, and that's your net working capital. You then take your net working capital line and you put it onto your cash flow. What's your cash flow? Well, your cash flow starts with your profit after tax, which you lift from your actual income statement, but you also lift it from your forecast income statement of how much money you think you've got to do, or you're going to make. So your profit after tax, you add back any depreciation if you had it to get your EBITDA. Then you add on the net working capital movement, which you've just calculated, and that gives you your cash flow from operations. Opening balance, which is the closing balance of your actuals. Your closing balance of your actuals plus by your net working capital movement is your closing balance for your forecast from your cash flow, which you then plug back into your balance sheet, and then everything should self-balance. I'm going to say all of that again, right? And this is what we've done. You create your P&L, you create your forecast P&L, which is your forecast of what you think you're going to do in the next 12 months. And you make that off the back of your forecast P&L. You use creditor days, debtor days, and stock days to model the balance sheet, and they're formulas which model the balance sheet, and they give your trade debtor closing balances for every single month. They give you your trade creditor balances for every single month, and they give you your stock for every single month. And you model each of those out. And you, while they're on your balance sheet, and you also put them on your schedule for net working capital. You put that lower down on your spreadsheet. Now you're almost done, but what you need to get your opening position, your jump off position, which could be 0 if you've never traded before, but it's unlikely to be. It's likely to be your actuals, and you get your actuals and you plug them in to your balance sheet, and you plug them into your net working capital. And now, because you have a starting point and you have a closing point at each month, you can then take your net working capital movement, which is the difference. It's the prior month minus the current month of your balance sheet added up. So you're comparing one balance sheet to the next balance sheet, taking the difference, and you put that onto your cash flow in the line net working capital movement. And then on your cash flow, it starts off at profit after tax, add back depreciation, movements in net working capital. That gives you cash movement in the month, and you add that cash movement to whatever the closing balance was from last month. And obviously, when you start, that is your actuals. Yeah, your closing actuals are the jump off point for your opening balance, your model. And that you have opening balance, movement of cash, gives you closing balance of the first month of your forecast, and you take that balance and you put it into your balance sheet, and then everything balances because it all self-regulates. Now, chances are when you do that, it's not going to work, right? And the reason it's not going to work is because you're likely to be missing items from your balance sheet. But it is exactly the same principle, yeah, for debt days, stock days. Anything that is on your balance sheet, if there is a movement on it, you need to put it into your net working capital schedule. You have to make sure it's captured. And once you know it's captured, then you're capturing that cash movement, and then it will regulate. Yeah. If your cash on your cash flow is not balancing to the balance sheet, then that means that there is something missing from your cash flow. So there we are, right? That's kind of like an introduction into financial modeling. I had actually planned for it to be kind of a longer video, but I think probably the best way is I'll go and do a series of these, and basically you can contact me with any questions or what you want me to dig in more, any help, and I'll make a video on that. Anyway, thanks a lot, guys. Bye bye.